Today, we cast our gaze down under to Australia, where the insatiable beast of the state is preparing yet another assault on private property and economic sanity. They call it a tax adjustment, a minor tweak for fairness. But let's call it what it is: a plan to tax unrealized capital gains, a policy so economically ignorant and morally bankrupt it threatens to cripple the Australian economy. Before we get started, if you want to reduce your taxes to single digits, make your assets impossible for anyone to touch, and gain more freedom with second citizenships, get in touch with Liberty Mundo and book a consultation call. We will help you develop a complete blueprint to organize your life to safeguard your wealth and your freedom. Follow the link in the description for more details. Now back to Australia's Unrealized Gains Tax. Make no mistake, this isn't just about superannuation funds exceeding $3 million, though that's the current target. This is about establishing a dangerous precedent. The state claiming a right to wealth you haven't even received yet. They propose taxing the paper increase in the value of your assets, year after year, even if you haven't sold anything, even if that gain evaporates tomorrow. Imagine this: you own shares that go up in value on paper. The government declares you've made a gain, a phantom gain, mind you, and demands 30% of it in cash. You might have to sell perfectly good long-term investments just to pay tax on money you never actually saw. What happens next year if the market crashes and your paper gain becomes a paper loss? Does the state give the money back? Don't be ridiculous. The plunder once seized is gone forever. This isn't taxation based on reality, it's confiscation based on guesswork. It's like taxing a farmer on wheat that's still in the ground, or taxing you on next year's salary before you've worked a single day. It's an attack on the very idea of property rights. It says your assets aren't truly yours, but held only at the whim of bureaucrats who can demand a cut of hypothetical profits whenever they please. The politicians, of course, try to soothe us. It only affects the rich, they coo, just 0.5% of super accounts. Don't fall for this statist shell game. First, the principle is poisonous. If they can tax unrealized gains over $3 million today, what stops them from lowering it to $1 million or $500,000 tomorrow? Once the door to taxing phantom wealth is opened, it will never be closed. Second, that $3 million threshold isn't indexed to inflation. That's by design. As government printing presses inevitably debase the currency, more and more ordinary savers will be dragged over this arbitrary line, not because they got rich, but because their dollars became worth less. It's a stealth tax, a slow-motion confiscation aimed squarely at the prudent middle class. Third, and most critically, this ignores why people have large savings. Those large superannuation balances, especially in self-managed super funds, aren't just sitting idle. They are vital pools of investment capital. As Australian fund manager Jeff Wilson rightly points out, these funds are often the lifeblood for innovative startups, the angel investors willing to take risks that fuel job creation and progress. What happens when you tax their paper gains? You kill the incentive to invest. Why risk capital in a new venture if the government penalizes you annually before you see a single dollar of real return? The rational response is clear: capital will flee. It will be withdrawn from productive enterprises. Jeff Wilson estimates a staggering $155 billion could be pulled from super funds. Where will it go? Perhaps into already inflated housing markets, making homes even less affordable. Perhaps it will leave Australia entirely, seeking shores less hostile to capital. The seed corn of Australia's future prosperity will be scattered to the winds. Think about a success story like Canva. It started worthless on paper, backed by investors betting on its potential. If this tax existed then, would those early backers have endured crippling annual tax bills on phantom gains? Would they have been forced to sell early, starving Canva of the capital it needed? This tax is a direct threat to the next generation of Australian innovators. And why this absurd focus on unrealized gains? It reveals the state's incompetence. The large industry funds, often cozy with unions, apparently lack the accounting systems to track realized gains properly. So instead of fixing their own systems, the government opts for this crude, destructive tax because it's easier for the bureaucracy. Economic reality and individual rights be damned. This tax isn't just stupid, it's deeply immoral. It punishes success, saving, and long-term thinking. It encourages consumption today over investment for tomorrow. It forces people to sell assets based not on market logic, but on the taxman's arbitrary demands. It's like taxing wages before they're earned, an outrageous claim on wealth that doesn't even tangibly exist yet for the individual. We've seen this movie before. Wealth taxes, built on the same rotten foundation, fail everywhere they are tried, driving out capital and crushing economies. Look at Norway, where the rich are literally fleeing the country to escape similar policies. Is that the future Australia wants? Australia faces a choice: the statist path of envy, intervention, and economic strangulation, or the path of liberty, sound money, secure property rights, and free markets, the only path to real prosperity. This tax on unrealized gains isn't a minor adjustment. It's a poison pill. It's an attack on property, on investment, on innovation, on the future itself. It must be seen for what it is, an attempt by the state to confiscate wealth before it exists. The economic future of Australia hangs in the balance. Thanks for watching, and I'll see you in the next one.